The next concept that Chapter 11 covers is that of transfer pricing. So transfer pricing occurs when one division inside a company transfers goods or services to another segment of the organization. These segments can be in the same building, they could be in different states, they could be in different countries. The fundamental objective of transfer prices is to motivate managers to act in the best interests of the company. We have three primary approaches to setting transfer prices: a negotiated transfer price, a set transfer price, or just using market price for the transfer. Which method we use depends on several issues such as capacity, market demand. So first we look at negotiated transfer prices. So this is when the managers from the selling and buying division sit down and have a meeting and talk about what prices they're willing to pay to negotiate something that is acceptable for both divisions. The managers have autonomy in making that decision, and they're going to choose a price that benefits the company as a whole. Under a negotiated transfer price, our range of acceptable transfer prices, the upper limit is determined by the buying division, and the lower limit is determined by the selling division. So the selling division says, I will transfer this to you. This is my lowest price. And the buying division says, this is the absolute most I will pay. And then they negotiate for something in that range of prices. So we have this example here of West Coast Plantations and Grocery Mart. They're both owned by the same company. So the plantation grows oranges and they harvest oranges, and the grocery store sells those oranges. So we have that the plantation produces their top capacity is 10,000 crates a month. They sell it on the market for $25 per crate. Grocery Mart purchase price of navel oranges is $20 per crate, and they can sell 1,000 crates. So when they're talking about creating a transfer price, that the lowest acceptable transfer price for the selling division is variable cost per unit plus any contribution margin lost on lost sales. And the buying division's highest acceptable transfer price is the cost of buying from an outside supplier. So if an outside player doesn't exist, then we would calculate it as the profit to be earned per unit sold, not including the transfer price. So let's put real numbers into that. So if we have sufficient idle capacity, then our lowest possible transfer price is equal to that of our variable costs. So as long as we're covering variable costs, that is the lowest price we will take. Those are the things that we have to consider. One, do we have capacity? Two, are our variable costs being covered? The buying division can buy them from an outside supplier for $20. So therefore, they're not going to pay any more than $20 for that from the internal supplier. So our range of transfer prices is $10 to $20. So the two managers of those divisions would sit down and select an agreeable price at any point between those two options. However, if the plantation has zero idle capacity, then the lowest price they are going to accept is market price. They're already at capacity. They're selling everything they own outside at the market. Therefore, they are not going to take anything below market rate. But the buying division is not going to pay anything more than what their outside supplier does. In this situation, there is no acceptable transfer price, and the plantation would continue selling on the market, and the grocery store would purchase from their outside supplier. If there is some capacity, but not all, and they must sacrifice other customer orders. So we have 500 crates of capacity, but in order to meet this full 1,000 crates of demand, we have to sacrifice 500 crates that can be sold on market. Then we're going to compute our variable cost plus the contribution margin of lost sales. So we have the $25 market price minus our $10 variable cost, which gives us the contribution margin, times the 500 crates that we would have sold to the outside, divided by the 1,000 crates, that's the total order. And we get a transfer price of $17.50. And of course, the buying division has not changed their mind. They're still only going to pay no more than $20. In this case, the transfer price is between the range of $17.50 and $20. If the transfer within a company results in higher overall profits for the entire company, there's always a range of transfer prices that both the selling and buying divisions could agree to. However, if managers end up competing with each other, they are reluctant to set transfer prices. So if there's a competition for maintaining a specific net income or always increasing your measurements, then you're not incentivized as a manager to transfer to internally at a lower price. So many companies don't rely on negotiation for their transfer price setting because of this issue. Many companies set the transfer prices at either the variable cost or the full absorption cost incurred by the selling division. The drawbacks of this approach mean that the selling division never shows a profit on any internal transfer, and there's no incentive to control costs within the organization. If there's a little bit of a profit markup for the second division that is still less than market, then there's still an incentive for the selling division. Transfers at market price are the best approach to the transfer pricing problem. However, the market price approach works best when the product or service is sold in its present form to outside customers and the selling division has no idle capacity. It doesn't work well when there's a lot of idle capacity or if it's a component price. Therefore, the product, the thing that is being transferred can't be sold unless it's further manufactured. And that means there's no outside market for it. So there's not really a market demand or market price. The last thing that we talk about in Chapter 11 is the allocation of service department costs. As we talked about earlier in the responsibility accounting area, these are cost centers. So these are centers that provide services to an organization, but they don't engage in any revenue generating activities. They just provide services to the operating department. For example, the accounting department provides payroll services to the manufacturing department and the sales department, but the accounting department doesn't sell their services outside for revenue generation. So how we allocate service department costs is always a question within companies. We charge them to the operating departments, one, to encourage our operating departments to use our company resources. So using internal resources versus going to an outside supplier, it helps to really measure the profitability of operating departments by showing true costs. It creates an incentive for service departments to operate efficiently and to provide more services within our company. The better service they provide, the better our entire company runs, and they give us more complete cost information for making full decisions. So how much does it really cost when we take into consideration all of those service and administrative costs? Variable and fixed service department costs should be charged separately. So because their behavior is different, we know that. So variable costs change in relation to activity, while fixed costs remain the same within that relevant range. So we should use whatever activity or cost driver causes the incurrence of the cost. For example, if we are a maintenance department that fixes our machinery, then machine hours would be a relevant cost driver or activity. Fixed service department costs are usually done in lump sums based on usage. So based on the amount of capacity each consuming department requires. And that shouldn't vary from period to period. Some departments are higher users than others, but we would know based on current use. So in this example, we have a maintenance department, and we have two operating departments within our manufacturing, cutting and assembly. We allocate costs for maintenance based on machine hour. So our variable costs are 60 cents per machine hour. And fixed maintenance costs are budgeted at $200,000 a year. We then have that the cutting department has 60% of capacity and the assembly department has 40% of capacity. And we have information about our budgeted machine hours and our actual used machine hours. When we do that allocation, we're going to use the actual hours of usage. So 60 cents per hour based on actual usage, and then the fixed cost allocation based on our percent of peak period capacity. So the fixed costs were 200,000. Therefore, of those costs from the maintenance department, we've allocated 168,000 to the cutting department and 104,000 to the assembly department. Allocating fixed costs using a variable cost that fluctuates from period to period is one of the things that we shouldn't do when we're allocating service costs. So we shouldn't use a fully variable rate by combining total fixed and variable costs and just allocating them based on a fluctuating amount. This is because the fixed costs that are allocated to any department are usually influenced by what happens in other departments. They're also usually influenced by percentage of usage instead of the actual activity of usage. We also shouldn't use sales dollars as an allocation base. So sales of one department influence the service department costs allocated to other departments. The problem with this is that if we just use a percentage of sales, this means that the highest sellers get more cost regardless of their usage of those services. This almost punishes departments for having really high revenues. And we don't want to give departments a kind of punishment by just allocating them extra costs based on the amount of sales that they do. The theory behind that practice of using sales dollars as an allocation base is this belief that departments with higher revenues have a greater ability to take on costs. But when we go back to that responsibility accounting of only giving managers costs that they have control over, if we allocate costs based on any other method than actual usage, then we're giving them non-controllable costs for their performance evaluation. Here's an example where we've used percentage of total sales instead of an actual usage amount. And so we allocate the service department cost to our three sales departments based on those sales. Now, in the next year, when the amount of those sales change, then the allocation also changes. So the new car sales go up, which means then they take on a larger percentage of those service department costs. Not because they're a greater use of those service costs, but just simply because their sales are higher than the other departments. And that is the end of chapter 11.